The thoughts of investing in stocks or ETF as a whole can be overly exciting for an average individual. More so, the thrill that comes with generating passive income as a whole could make investors dive at any recommended high dividend paying stock without considering the tax implications of doing so. In fact, as a finance professional with over a decade of experience, this is one major area of concern I have with investors as a whole, especially rookie investors. Now, it's important for you to remember that just like any other initiative or business idea, you cannot recognize revenue in isolation without considering the cost of generating such income or revenue as a whole. As such, it's very important for you to incorporate taxation and related costs into your investment decision making. In this video, I'll be showing you how to calculate your taxes on Canadian dividend, how to earn dividends with no taxes at all, and how to assess the net income you'll be getting from your dividend stocks in 6 simple steps. The information I'll be sharing with you should help you make a better informed decision around the kind of dividend stocks you're going to be buying going forward. I will also be showing you how to calculate your net income from foreign investment or foreign dividends, such as US stocks. However, I'll be doing that in a subsequent video in this series. Hey everyone, welcome to this channel. This is the Finance Wiz channel. My name is Ebuka. If this is your first time on this channel, ensure to like, share and subscribe so you don't miss any of the value I'll be dropping going forward. So this channel majorly focuses on topics around income generation, savings and investment, debt management, and overall financial freedom. So let's dive into the topic of today. But before I get into all of that, I want to establish a few facts that is very crucial. It is important for you to remember that all dividend income received will be taxed. If you buy your shares in non-registered or regular investment accounts, those dividend income generated from those stocks will be taxed. However, dividends received in your registered savings accounts such as RRSP, RESP, TFSA, RRIF are typically tax sheltered. So the major advantage of investing in Canadian dividend paying stock is that you get some tax credits, which are typically given to Canadian residents to reduce the chances of double taxation overall. It's also important for you to know that dividends in Canada have the lowest tax rates amongst all investment income. Now, let me show you the 6 steps which you can use to calculate your taxes on your Canadian dividend. So let's assume you're earning income of $105,000 and dividend of $100. So just as a reminder, like I've earlier mentioned, you can save on dividend taxes by purchasing with your registered savings accounts such as the RRSP, TFSA, and so on. Okay, so the first step you want to do is to determine if your dividend will be classified as eligible or ineligible dividend. Now, for the purpose of those that don't understand what eligible and ineligible dividends are, so for a dividend to be regarded as eligible, it must be designated by the organization or the corporation as eligible dividend. Secondly, the dividend must be from large Canadian businesses that pay higher taxes, usually a net income of over $500,000. Now, the dividends are usually taxed more favorably. In other words, you as the dividend receiver or the shareholder in this case will be receiving tax credit at a much higher rate. Now, you generally pay the lowest amount of taxes on eligible dividends compared to ineligible dividends. Now, of course, the reverse is the case for ineligible smaller businesses. You pay more taxes and your income is different. So you can actually determine if it's eligible or ineligible by simply looking at the announcement made by the organization that is paying that dividend. You can typically see it on their investor page on their website, or simply call their investor relation office to inquire about this information. So for now, you have to gross up your dividend. So the purpose of grossing up your dividend is simply to account for the portion of tax that the corporation had paid earlier before making the payment of those dividends to you. Now, as you can see from my screen, eligible dividend is grossed up at 38% and ineligible is grossed up at 15%. That is usually the standard rate in Canada. So when you apply 38% and you gross up $100, it brings you to 138. That's simply 138% times 100. It gives you $138. Same applies to 15% times 100, which brings you to $115. So the focus of step 3 is simply to determine your tax rate. Now, in Canada, the tax rate is usually tied to tax bracket, or in other words, your income bracket. So whatever income you're earning will definitely fall within a certain bracket that is clearly defined, as you can see from my screen. Now, by the way, this is from taxtips.ca. If you want to use that, you can go to their website to check it out. What I have here is a combined federal Ontario tax bracket. If you need that information in that level of details. Okay, so you can see the tax bracket based on a combination of federal and Ontario's requirements. Now you can see for the first 49,000, the next 49 to 53,000, 53,000 to 86,000, and onwards up to above 235,675. So your income will typically fall in one of those areas on any of those brackets, and that will determine the tax rate that we applied to your income as a whole. So like we earlier established, based on our assumption, we assume that this guy, or whoever it is in this case, is earning about $105,000 per annum. So $105,000 should clearly fall within this tax bracket of 98,463 up to 102,135. Now bear in mind that this is a combination of federal and Ontario's tax bracket. Now for other provinces there will also be such combination, or if you want you can calculate them separately for federal and calculate for your provincial and then add them up together. So like I earlier established, assuming the individual earns 105,000, you should be falling within the bracket of 37.91% as your effective tax rate. Now I can make reference, if you want to confirm how I got the 37.91%, you can simply go back to the previous slide to see the tax bracket that 105,000 falls within. Okay, now we've already grossed up the dividend, so step 4 is simply focus on calculating the tax on your grossed up dividend. Now this is very simple, just apply the effective tax rate to your grossed up dividend. We already calculated the grossed up dividend in previous steps, and now we are applying the tax rate which we already figured out in the last step. So as you can see from my screen, eligible dividend now becomes 138 times 37.91%, which means that the actual tax for eligible dividend of $100 will be $52.32. Now for the grossed up non-eligible dividend of $115, a 37.91% tax will be applied, making it 43.60. Now typically if you are taxed at this rate, it will be pretty high. Imagine paying $52.32 for a $100 dividend. That's quite high for many people. So if this was the case, a lot of people will probably not invest at all, because it's just going to be like, I mean, is it worth it, right? However, to balance all of this and to avoid this kind of double taxation, the government of Canada has decided that, you know, we're going to give you tax credit to reduce the impact of the tax implication on this, especially because the corporation had already paid taxes on this before. Now you're going to pay taxes again on this, so there has to be some sort of ease or tax credit for you. So that takes us to the next step, which is step 5. Now this is all about calculating your dividend tax credit. Like I said, the purpose of dividend tax credit is to reduce the impact of double taxation. So the corporation already paid tax and now you're going to be paying tax, so they have to find a way to reduce the impact on an average individual. So just like the tax percentage I earlier mentioned, there's a component that relates to federal and another component that relates to the provincial. In the same vein, the tax credit also has a portion that relates to the federal and the portion that relates to the provincial. Now I'm just going to show you what the provincial tax credit would be for both eligible and ineligible dividends. Now if you look at my screen, different provinces provide tax credits at different rates to their residents. For example, if you take a look at this screen for 2022-2023 period, you can see that for Alberta it's 8.12%, you can see for Nova Scotia it's 8.85%, you can see for Ontario it's 10%, you can also see for PE and so on at different rates. Now you can also see the federal component for this, which is 15.0198%. Like I said, the federal remains the same of course, and then the provinces have their different tax credits. Now this is strictly for eligible dividends. So if you go a step down, you'll see for non-eligible dividends, and the federal rate for non-eligible dividend is 9.0301, and you're going to see how I would apply those rates into our calculation overall. All right, now you can see that for non-eligible dividends you have a 2.18% tax credit in Alberta. Now the same applies to BC, where you have 1.96, and so on. New Brunswick, you have 2.75%. Ontario, you have 2.9863%. So different provinces have their rates for tax credits. Now you need to know how you can apply or select it depending on your location. So now let me show you how it is applied. Very simple. Now you already know from the previous slide that the federal and the provincial will always have different tax credits for your eligible and non-eligible dividends. Now from that previous slide you can see that the federal was 15.0198% and Ontario, which is the one I'm using for this sample, is 10% for eligible. Alright, now if you combine both of them and apply to your taxable eligible dividend, it will come to 25.0198%. That's to say 15.0198 plus 10%, making 25.0198%, right? Now multiply that percentage by $138, which is our grossed up dividend. You should get $34.53. All right. Now, the same vein, non-eligible dividend, there was a federal tax credit of 9.0301%. Ontario had 2.9863%. When you add the two of them, it should give you about 12.0164%. Now, multiply that percentage by the grossed up dividend of $115. That gives you $13.82. Now, all of this is your tax credit. So you have to apply your tax credit to your tax payable to determine what your net tax would end up becoming. I'm going to show you that in the next slide. So now this brings us to the next step, which is my step 6. Now this is all about calculating your net tax payable. Now pretty simple. We already followed a number of steps to arrive at this point. Now you need to know what is actually coming to your account, net income, right? So remember, whatever dividend you get is usually not your total dividend, it is your gross dividend. All right, so now you need to know the net effect for the purpose of your financial planning or whatever decision making you want to do regarding your dividend income. Now take a look at this screen. You can see that for eligible dividend, the tax payable was $52.32, which we had earlier established by applying our tax rate to our grossed up dividend. Okay, now with the tax credit of $34.53, it nets off from $52.32 to give you a net tax payable of $17.79. That's to say, for a $100 eligible dividend, you'll be paying only a paltry sum of $17.79. On the other hand, the non-eligible, as you can see, the tax payable of $43.6 is reduced by the tax credit of $13.82 here, and this gives you a net tax of $29.78. Now, clearly comparing both of them, you can tell that the non-eligible results in you paying more tax compared to the eligible. So it's fair to say you're paying about 18% for eligible dividend and 29.8% as your tax on your ineligible dividend, which at the end of the day is pretty much cheaper than many other sources of income, such as your employment income, your capital gains, and many others. So dividend tax is pretty cheap compared to other forms of income. Now, it's not enough to just calculate all of that. There are other factors which you need to take note of that's very crucial. For instance, you might ask me, what if I'm a low income earner and I'm getting dividends? How is it going to be calculated? Very simple. Now, you need to know that regular federal taxes start to be payable when your actual eligible dividend reaches the amount of $68,558. And also, the alternative minimum taxes starts when your dividend reaches $55,002. Now, what does this actually mean to you as an individual if you're a low income earner? Now, what this simply means for an average individual that is earning only dividend income is that you will not be required to pay taxes until you get to $55,002. Now, between $55,002 earnings to about $68,558, you'll be paying only the minimum tax. Now, if your sole source of income is dividend income and you're earning below the threshold of $55,002, there's a likelihood that you'll be getting a negative tax amount as a result of the tax credit which I earlier explained. Now, the negative tax amount is non-refundable. However, it can be used to offset any other tax payable in your personal income tax. Now, you might actually ask me, how do I do away with paying taxes completely as a dividend earner? I'm going to show you how this can happen so that you can plan your investments accordingly. Firstly, you need to remember that you're taxed in Canada based on your tax bracket. Canada adopts a progressive tax system which is tied to each of those tax brackets like I earlier showed you. Therefore, your dividend being tax free is dependent on whether it's your only source of income or you have alternative sources of income in addition to your dividend. Like I earlier mentioned, you can earn eligible dividend of up to $68,558 without being taxed. However, when you hit $55,002, you'll be subjected to alternative minimum taxes. So in the case of non-eligible dividends, on the other hand, you'll be allowed to earn as much as $31,361 before taxes become applicable. So another instance where dividend taxes may not be applicable is when dividends originate from mutual funds or regulated investment companies that are exempt from taxation overall. Now, this exemption is simply because they invest in tax-free securities. These kind of dividends are called tax advantage accounts or non-taxable dividends. Now, it's very important for you to determine if your dividends received or receivable is going to be subjected to tax so you can plan your tax strategy effectively. Similar to all other forms of investments, it is crucial for you to do your due diligence and determine your applicable tax rates so you can make investments that will yield long-term advantages. This consideration is even more important, especially if you opt in for foreign investments such as US stocks or any other international stocks, because their tax rates will be typically higher than Canadian dividend taxes. Alright, I hope you found this very helpful and insightful for your decision making to determine the kind of dividends you want to invest in going forward. And like I earlier promised at the beginning of the video, I'm going to be doing another video on foreign investments and how to calculate the taxes applicable to them to help your overall decision making. Okay, thanks for taking the time to watch me, and like I said, ensure to subscribe to this channel to get more insightful and valuable videos going forward. Thank you and see you at the next video. Bye.